Hey there, curious minds. Ready to jump into something truly fascinating with us today?
We sure are. We're taking a deep dive into something called audit data analytics, or ADAs for short.
ADAs, right? And these aren't just like fancy new spreadsheets, are they?
Oh, not at all. They're fundamentally reshaping how auditors actually do their work. It's quite a shift.
Okay, so our mission today then is to give you a real handle on these ADAs. We want to unpack what they are, how they work, and maybe most importantly, why they're so crucial now with all this data flying around.
Exactly. We want to give you that shortcut to being well-informed, hopefully with a few aha moments along the way.
All right, let's kick things off. Audit data analytics. What are we actually talking about here? What's the core idea?
Well, at their heart, ADAs are basically sophisticated ways for auditors to analyze data. And not just financial data, but non-financial data too. Huge amounts of it.
Okay, analyze it for what purpose?
The main goal is to find things. Patterns, hidden relationships, anomalies, things that might be missed if you're just looking at small samples.
Yeah.
It's about digging deep into the information during an audit.
And why the big boom in ADAs right now? Is it just better computers or is there more to it?
It's really a convergence of factors. I mean, first, there's just an explosion of data available, right? Thanks to IT being everywhere in business.
Yeah, data's everywhere.
And at the same time, the technology auditors use, the analytical tools,
Yeah.
they've gotten incredibly powerful.
So more data and better tools to look at it.
Precisely. And that combination has really fundamentally changed how audits are done. It's a whole new landscape.
It sounds like moving from, looking at individual trees to suddenly seeing the whole forest from above.
That's a great way to put it. It gives auditors a much broader, deeper perspective.
And the reach of these ADAs, it
Yeah.
sounds pretty wide.
Oh, incredibly wide. You can use them in pretty much every phase of an audit.
Like what? Give us some examples.
Okay, so risk assessment procedures, definitely. Testing internal controls, doing substantive testing, even helping to form the final overall audit conclusion.
Wow, so really end to end.
Yeah, and what's really efficient is that sometimes a single ADA can achieve multiple things at once.
How so?
Well, you might run an analysis that gives you evidence for your risk assessment and also serves as a substantive test, provided, it meets the objectives for both. Kill two birds with one stone, so to speak.
That's smart. Which brings us to the benefits. You mentioned efficiency, but what else do ADAs bring to the table? It sounds like more than just saving time.
Oh, much more. It
Yeah.
leads to a significantly deeper understanding of the client and their business. You really get under the hood.
Which probably means better risk assessment, right? Finding risks you might have missed otherwise.
Exactly. Uncovering risks in areas that might have just flown under the radar before.
And you mentioned samples earlier. ADAs let you go beyond that.
Absolutely.
Yeah.
That's a huge one. You can often test entire populations of data instead of just small samples. Think about the level of assurance that gives you.
That's a massive shift, testing everything.
It is. Plus, you gain new insights from looking at things like metadata or connecting internal data with external data sources. And yes, there's increased efficiency, much better fraud detection capabilities,
Fraud detection, yeah, that's always critical.
and even improved communication. Because you can use data visualizations to really clearly show what you found.
Okay, so the benefits are pretty compelling. If an auditor wants to start using ADAs, is there a standard process? How do they actually go about applying one?
Yes, there's generally a structured five-step process that auditors follow to make sure they're doing it effectively.
5 steps. Okay, what's step 1?
Step one is all about planning. You've got to plan the ADA.
Makes sense. What does that involve?
It means figuring out the objective.
Yeah.
What are you trying to achieve? What's the purpose? Which part of the company or which accounts are you testing? Then you need to identify what data you actually need, decide on the best ADA technique to use, and figure out what tools you'll use and how you'll evaluate the output. It's like drawing up the battle plan.
Got it. So plan meticulously first. What's next?
Step two is access and obtain the data. You need to actually get your hands on the data you identified in step one.
Which might come from different systems, I imagine.
Often, yes.
Yeah.
And crucially, once you get it, you have to clean it and validate it. Make sure it's complete and accurate.
Ah, the garbage in, garbage out principle.
Exactly. Data quality is absolutely paramount.
Okay, data obtained and cleaned. Step 3.
Step three is review and analyze the data. Here, you're looking closely at the data you sourced and assessing its relevance and reliability for your planned procedure. Is this really the right data? Can we trust it?
Makes sense. Checking it again before you use it.
Then, step four is the main event. Perform the ADA. You actually run the analysis using the tools and techniques you decided on earlier.
Okay. Run the analysis. And finally,
Step 5 is evaluate and address outcomes. Did the ADA achieve the objective you set out in step 1? Was it performed correctly? And based on the results, do you need to maybe tweak the analysis or perform additional audit procedures? It's that crucial feedback loop.
plan, access, review, perform, evaluate.
Got it. Now, you mentioned tools. Can auditors do this manually, or is it all software driven?
Well, technically, you could do very simple things manually, maybe with spreadsheets, but honestly, for the volumes of data we usually see, it's incredibly tedious and inefficient. So yeah, specialized software is definitely the norm.
Right. Who wants to sift through millions of lines of data by hand? So what kinds of software are we talking about? What's in the auditor's digital toolkit?
We can generally break the software down into a few main categories. First up, you have tools for data extracts and preparation, often called ETL tools: extract, transform, load.
ETL. Okay, what do they do? Their job is to connect to all the different places data might live, pull it out, clean it up, fix errors, deal with inconsistencies, scrub it for integrity issues, make sure it meets quality standards. They also handle things like normalizing data, combining different data sets, and summarizing it.
So they get the raw data ready for analysis.
Exactly. And a really neat feature is that they can often automate these steps. You set it up once, and it can run again easily, which is great for repetitive data collection tasks.
What kind of tools fall under ETL, like specific examples?
Sure, think advanced spreadsheet functions, database query tools like SQL Explorers, specific data transformation software, and even things like robotics process automation or RPA software, which can automate those manual data handling steps.
Okay, those are the workhorses getting the data prepped. What's next?
Once the data is clean and ready, you often use data modeling software. Yeah, these are platforms that help you apply common analytical procedures. Some are even specifically designed for audit tasks, like running Benford's law tests or doing statistical sampling. For really complex models, they might even leverage cloud computing power.
So this is where you start doing the actual analysis, finding patterns.
Pretty much. Examples here include dedicated data analytics software, maybe some plugins for other tools, data mining software, or even custom programming scripts if needed.
And once you've done the analysis and found something interesting, you need to show it, right?
Absolutely. That brings us to the third category, data visualization software.
Making charts and graphs.
Exactly,
Yeah.
but often much more sophisticated. These tools create charts, graphs, diagrams, dashboards, ways to make complex results easy to understand at a glance. They highlight trends, relationships, how data is composed.
So people can actually see the story the data is telling.
Precisely. And some advanced tools can even generate visualizations based on simple text prompts, which is pretty amazing for exploring data quickly.
Wow. Examples here.
Standard charting tools, specialized data viz software, and even things like natural language processing, or NLP tools, which can help summarize findings, or even generate narrative descriptions from the data. Okay, ETL, modeling, visualization, that's a powerful toolkit. Now let's talk about the techniques, the actual analysis methods. You said they range from simple to complex.
Yeah, there's a whole spectrum. It can be as simple as sorting or filtering data in a spreadsheet, all the way up to advanced techniques like classification or machine learning. And generally, the more complex the technique, the deeper the insights you can potentially get.
So can we categorize these techniques somehow?
We usually think about them in 4 broad categories, kind of moving up a ladder of analytical power.
Okay, what's the first rung?
That would be descriptive analytics. These techniques basically tell you what happened or what is happening right now in the data. They give you a high-level summary.
Like averages and things. Exactly. Summary statistics mean median, standard deviation, correlation. Also things like binning, which is grouping data, like creating an aging schedule for receivables. Basic stuff, but foundational.
Can you give an example?
Sure. Let's say Kenneth is auditing a restaurant chain, Charter Eatery Corp. Their places are closed on Sundays.
Okay.
Kenneth runs summary statistics on all sales transactions. Then he applies a simple filter, a descriptive technique, to just show transactions recorded on Sundays.
And if anything pops up?
Exactly. If transactions show up on a day they should be closed, that immediately flags something to investigate further. It's simple, but very effective for spotting basic anomalies.
That makes perfect sense. A simple filter reveals a potential issue. Okay, so that's descriptive what happened. What's next?
Next up is diagnostic analytics. This level aims to figure out why something happened. It's about finding correlations, patterns, reasons behind the numbers.
So digging a bit deeper, what techniques are used here?
Things like clustering data points together, drill down and drill through analysis, data mining, variance analysis, comparing period over period, data profiling, checking sequences. Lots of ways to explore relationships.
Drill down sounds interesting. Can you illustrate
Yeah,
that?
let's take Tracy, auditing Maroney Publishing. She calculates the current ratio for the last 3 years and notices a big, unexpected drop between year 2 and year 3.
Okay, that's the what, now the why.
Right. So Tracy uses drill-down analysis. She breaks down the current ratio into its components, current assets, and current liabilities. She sees most accounts are stable, but short-term debt has shot up. So she drills down again into the short-term debt account, and boom, she finds one very large transaction, a short-term note taken out to buy new fixed assets.
Got it. So the drill down pinpointed the exact cause of the ratio change.
Precisely. It explained the why and told her exactly where to focus her next audit procedures testing that specific large note.
Very cool. Okay, descriptive diagnostic. What's level 3?
Level 3 is predictive analytics. Now we're using historical data to make educated guesses or predictions about what might happen in the future.
Okay, forecasting and things like that.
Exactly. Techniques include regression analysis, forecasting, time series modeling, classification, even sentiment analysis.
Sentiment analysis, how does that fit into an audit?
It can be surprisingly useful. Let's say Elizabeth is auditing SGT retailers. She wants to assess fraud risk around their top-selling TV model.
Okay.
She uses sentiment analysis tools to scan social media posts about that TV. She finds a lot of negative comments, people complaining about it.
Uh-oh. You'd expect high returns then, right?
You would. But when Elizabeth looks at the company's records for the audit year, she sees very few returns for that TV model during Q3 and Q4.
That's weird. Negative buzz, but low returns.
Right. So she digs deeper. And she finds an unusually high number of returns for that specific TV model processed in the month just after the year end.
So maybe they were delaying processing the returns. Or something else fishy.
Exactly. It flags a potential issue with the timing of recognizing returns, possibly an error or even intentional manipulation. Using external, unstructured data like sentiment provided a predictive clue.
That's fascinating, using social media buzz as an audit tool. Okay, what's the final level? The top rung.
That's prescriptive analytics. This is the most advanced category. It builds on predictive insights and aims to answer, how can we make something happen? It recommends specific actions to optimize outcomes.
So, telling you what to do about the future.
Sort of, yeah. Techniques here include what-if analysis, building decision support systems, using machine learning, and natural language processing, NLP.
Can you give an example here? This sounds pretty complex.
Okay, imagine Petra auditing Parcel Corp. Their accounts payable process is very manual. They get paper invoices, someone keys them in.
Okay, old school.
Petra takes a sample of these physical invoices and scans them, digitizing them. Then she uses optical character recognition, OCR, to turn the images into machine-readable text.
Right, converting the picture to text.
Then she applies NLP. The NLP model is trained to automatically pull out key information from the invoice text vendor, name, date, amount, invoice number.
Wow, automatically reading the invoice.
Yes. And then it matches that extracted info against the company's detailed listing of paid invoices, automatically flagging any discrepancies.
So instead of someone manually checking everything, the system does it.
Exactly. It prescribes a much more efficient and potentially more accurate way to perform that test, moving beyond just finding problems to suggesting optimized actions or processes.
Incredible. Descriptive, diagnostic, predictive, prescriptive. A clear progression in power. So we know the types. Where do auditors typically apply these ADAs in an audit?
Well, the decision always comes down to the specific audit objectives and whether you can get good data. But they could be used almost anywhere.
Let's start with risk assessment. How do ADAs help there?
They're huge for risk assessment. They can help identify risks that weren't previously on the radar, assess the likelihood of material misstatements, both overall and for specific accounts, pinpoint potential fraud risks, and help decide what further audit work is needed.
Got an example?
Sure. Costanza Retail has 5 stores. The auditor wants to assess risk by comparing quarterly sales across locations. They use a simple descriptive ADA, maybe visualize it as a column chart.
Okay.
The chart immediately shows that one store had a massive jump in sales between Q3 and Q4, way out of line with the others.
Red flag right there.
Exactly. That visual makes the anomaly pop out, signaling the need for more substantive testing focused on that specific store's Q4 sales. It directs attention effectively.
Makes sense. What about tests of controls? How do ADAs fit in there?
They can be really powerful for evaluating if internal controls are designed well and actually working. Well, you could use external data to confirm control outcomes. or use internal data analysis to support or contradict management's claims about control effectiveness. You can also look for anomalies in large data sets that might indicate a control failure, or even use ADAs to help reperform a control activity much faster than manually.
Can you illustrate that?
Okay, let's say at Tillman Financial, the auditor needs to check if IT access is promptly removed for employees who've left the company.
A common control?
Right. The auditor could use a diagnostic ADA with fuzzy logic. This lets them search the employee termination list against the active user access logs, even if names aren't spelled exactly the same way, like Smith John versus John Smith.
Ah, so it catches near matches too.
Yes, this helps identify instances where access might not have been revoked properly, giving much stronger evidence about that control's effectiveness than just checking a few examples manually.
That's much more thorough. Okay, risk assessment, tests of controls. What about substantive procedures, the part where you're directly looking for misstatements in the financials?
ADAs are excellent here for both test of details and substantive analytical procedures.
Let's break that down. How about for tests of details?
For details, you can do things like sequence checks on entire populations of pre-numbered documents, like invoices or checks, looking for gaps or duplicates. You can test every single transaction in a file for accuracy against certain criteria. You can compare transaction data against external sources, or analyze the structure of data fields to find missing or inconsistent information.
Testing the whole population again, that seems to be a recurring theme.
It's a major advantage. The ability to look at everything, not just a sample, is huge for tests of details.
And for substantive analytical procedures.
ADAs are a natural fit, comparing current year numbers to prior years or to industry trends. Developing expectations for balances using techniques like regression, period-over-period analysis, trend analysis, classification, ratio analysis. ADAs make this much faster and more robust.
And the drill down capability you mentioned earlier.
Crucial here too, if your ADA develops an expectation and the actual number is significantly different, you can quickly drill down to investigate why.
Give us an example of a substantive analytical procedure using an ADA.
Okay, Heenan Auto runs 12 mechanic shops. The auditor wants to test revenue. They use regression analysis. They gather 3 years of data on gross revenue, labor hours, and materials expense for each shop.
Looking for a relationship there.
Exactly. The ADA confirms a strong statistical relationship revenue is driven by labor and materials. So the auditor uses this validated model to predict what the current year's revenue should be for each shop based on their current labor and materials costs.
Setting a precise expectation.
Right. Then they compare the actual reported revenue to this ADA-generated expectation. Any shops with significant variances get flagged for more detailed investigation.
That's much more sophisticated than just comparing to last year's number.
Definitely. Okay, one more area. Concluding the audit, how do ADAs help wrap things up?
At this final stage, the auditor knows the client really well. ADAs can provide a final, high-level overview, similar to risk assessment, just to gain comfort that nothing material was missed.
Kind of a final sanity check using data.
Exactly. And what's neat is you can incorporate any adjustments or updated figures found during the audit into these concluding analytics, so you can see how those changes impact overall trends and ratios right before signing off. A final look at the big picture with the most up-to-date numbers. Makes sense. We've covered a lot what ADAs are, the benefits, steps, tools, techniques, applications. But you mentioned earlier, none of this works without good data.
Absolutely critical. The foundation of any ADA is the data itself. It has to be complete, accurate, relevant, and reliable.
Garbage in, garbage out.
You got it. So auditors spend significant effort identifying what data they need, figuring out where it lives in the client's systems, how to get it out, and then crucially, verifying its reliability.
Where does this data typically come from?
All over the place, really. Core systems like ERPs, accounting systems, CRM systems for customer data, supply chain management systems, even data from connected IoT devices.
And external sources too, right?
Yes, things like government databases, industry statistics, data from third-party service providers the company uses.
And this data comes in all sorts of formats.
Oh yeah, simple text files, CSVs, Excel spreadsheets, database files, XML files which has data structure embedded, specialized formats like hypercubes for fast analysis, compressed zip files. Auditors need to be able to handle all sorts.
The challenge sounds like getting all these different formats and sources into one usable state.
That's a big part of the ETL process we talked about. Extracting, transforming it into a consistent format, and loading it into the analysis tool.
And we're dealing with different types of data too, right? Not just numbers.
Correct. Broadly, you have structured data and unstructured data.
Structured data is the neat stuff. Rows and columns.
Pretty much. It's organized, has a consistent format, easy to search. Think spreadsheets, databases with tables, attributes, columns, and records, rows. Relational databases are key here.
Relational databases. Those use keys to link tables, right?
Exactly. Primary keys uniquely identify a record in one table, and foreign keys link it to records in another table. This reduces redundancy. You don't have to repeat the same customer info in every single order table, for example.
That process of reducing redundancy is called normalization.
Yes. Think about college student data. Instead of one giant spreadsheet repeating a student's name, address, etc., for every single course they take,
Which would be messy and repetitive.
you normalize it. You have one table with student info, name, address with a unique student ID as the primary key, another table with course info, unique course ID, and a third table linking them, student ID, course ID, showing who is enrolled in what. Much cleaner, less redundant, easier to update.
Makes sense. So that's structured. What about unstructured data?
That's basically everything else. Data that doesn't fit neatly into rows and columns. It's often in its original format, harder to sort or query using traditional methods.
Like what?
Social media posts, emails, transcripts from interviews, sensor data from machines, videos, images. A huge amount of data is unstructured. You often find this in what's called a data lake.
Okay, so regardless of whether it's structured or unstructured, sourced from inside or outside, how do auditors actually check if it's reliable?
That's a multifaceted process, data reliability verification. A big part is understanding and testing the client's general IT controls, or GITCs. If the system generating the data isn't reliable, the data itself probably isn't either.
So testing the system's controls first. What else?
Lots of procedures. Auditors might create flowcharts to understand how data moves. They'll perform tests of controls over specific data processes. They might use external confirmations. Recalculation and reperformance are common. If data comes from a service organization, they'll review that organization's SOC1 report.
What about comparing data sources?
Absolutely. Comparing the data to other internal sources, or even better, to independent external sources. Sourcing data directly from third parties, if possible. Performing sequence tests. Using validation totals like batch totals or record counts. Running summary statistics to see if they look reasonable.
You can also check known relationships, right? Like beginning balance plus activity equals ending balance.
Yes, reconciling data is key. Making sure transaction data rolls up correctly to subledgers, then the general ledger, then the financial statements. Sometimes you might even need help from a specialist.
Can you give an example of how reliability testing might lead to further analysis?
Sure. Let's say Sherman CPA is testing equity accounts. They reconcile retained earnings from beginning to end, validate dividends against external records, check net income against tax filings, basic reliability check.
Okay, confirming the numbers tie out.
Then, as part of this, Sherman calculates the debt-to-equity ratio and sees a massive, like 45% jump from the prior year.
Whoa, that's huge.
Right. Because they trust the underlying data now, that huge jump immediately triggers a more advanced analytic. Sherman decides to run a classification analysis comparing Parcel Corp's current financial ratio profile to profiles of similar companies that recently declared bankruptcy.
Trying to predict bankruptcy risk based on that reliable but alarming ratio change.
Exactly. The reliability work gave them confidence in the numbers, which then justified deploying a more sophisticated predictive ADA.
And what makes data generally more reliable in an auditor's eyes?
Generally, reliability increases if the auditor gets the data directly themselves, if it comes from an independent source, if the client's internal controls over the data are effective, if they get original documents rather than copies, and if the evidence is well documented, not just based on conversations.
Okay, so data sourced, verified, now you have results, maybe visualized. How do auditors make sense of that output?
Yeah, the output, the charts, the reports, the lists of exceptions, it has to be usable. Auditors need to be able to look at it and quickly understand the key insights, see the relationships, spot trends, identify outliers, and assess risks.
And it might take a few tries to get it right?
Often, yes. It could be an iterative process.
Yeah.
You look at the output and maybe you realize you need to tweak the parameters of your ADA, filter the data differently, or maybe even use a different technique altogether and run it again. It's about refining it until it effectively addresses the audit objective.
You mentioned visualizations being key. How important is good design there?
Hugely important. And it's not just about making it look pretty. It's about ethical and effective communication.
What do you mean?
Well, you need to choose the right type of chart for the data and the message. A pie chart shows proportions. A scatter plot shows relationships. A line chart shows trends over time. Using the wrong one can be misleading.
And scaling matters too, right? Like starting the y-axis at 0.
Absolutely. Manipulating the scale can exaggerate or minimize changes. Using appropriate colors is important too, considering accessibility and cultural norms. The main thing is that the visualization should clearly highlight the key findings relevant to the audit objective without introducing bias.
Okay, let's talk interpretation. How do auditors interpret the results from some common techniques using these visuals? Maybe start with regression analysis.
Okay, regression looks at relationships between variables, like maybe office supplies expense related to number of employees. You often see this visualized as a scatter plot. Each dot is a data point, like a month's expense versus employee count. The regression line shows the statistical trend.
And if the dots are close to the line,
If the dots cluster tightly around the line and you have a high R-squared value, it indicates a strong relationship. Auditors can then use that relationship with confidence to predict expected expense based on employee count in the current period.
got it. How about variance analysis? Comparing actual to budget.
Bullet charts are great for this. You'll see a bar representing the actual amount for an expense, say supplies expense, and right alongside it, a line or marker showing the budgeted amount.
Easy to see if you're over or under.
Exactly. Auditors can quickly scan this for significant variances, maybe anything over a 10% difference flags it for investigation. You might see multiple expenses lined up this way: COGS, utilities, selling expense, etc., all compared to budget visually.
Clear and concise. What about period over period analysis?
Simple bar or column charts work really well here. You might have columns showing net income for Q1, Q2, Q3, Q4 of year 1 right next to the corresponding columns for year 2.
Making side-by-side comparison easy.
Yep. Any big differences in height between the year 1 and year 2 columns for the same quarter would jump out and require explanation.
Makes sense. And classification, that predictive one.
Right. Classification predicts categories. You could use a scatter plot, again, maybe plotting net income versus revenue. And the points are color-coded or shaped based on the predicted category, like low earnings years, moderate earnings years, high earnings years.
You see clusters of similar performance.
Exactly. Or you could use a pie chart to show the proportional breakdown, like sales by state, showing the percentage contribution from New York, Alabama, Virginia, etc. The key here is looking for outliers data points that don't seem to fit neatly into their predicted category or cluster. Those often warrant a closer look.
Outliers often tell a story. Okay, one more. Trend analysis.
Best visualized with line charts. You're typically looking at a value, like net income, plotted over several periods, months, or years. You want to see the direction of the trend.
Going up, down, staying flat.
Right. Auditors compare this trend to expectations, like prior years or industry trends. If an account balance trend is suddenly moving in the opposite direction of related accounts or industry benchmarks, that inconsistency needs investigation.
So these visuals make spotting issues much faster. Once the auditor spots these potential issues, outliers, variances, weird trends, what's the next step?
That's where evaluating and grouping potential misstatements comes in. The ADA might flag a bunch of items. The auditor needs to sift through them.
How do they organize that?
They usually group them into 2 buckets. Bucket 1 is clearly inconsequential.
Meaning?
These are items that, even if they are errors, are so small individually and altogether that they pose no risk of making the financial statements materially misstated. The auditor just needs to document why they think these are trivial.
Okay, the small stuff gets set aside. What's bucket 2?
Bucket 2 is not clearly inconsequential. These are the items that might be part of a material misstatement or indicate a risk.
So the ones you need to worry about.
Right. The auditor might group these by common characteristics, try to figure out the potential misstatement amount involved, and do more analysis. If items still seem potentially problematic after this closer look, they remain not clearly inconsequential.
And what happens to those not clearly inconsequential items?
They trigger additional procedures. The auditor has to design specific follow-up tests to figure out what's really going on.
What kind of procedures?
It really depends on the situation and the auditor's judgment. They'll consider the size of the potential issue, whether it looks like fraud, if it points to a breakdown in controls, and then decide what kind of further testing is needed, maybe testing the whole population related to the issue, or perhaps just a targeted sample.
So the ADA points you to the smoke, and additional procedures check if there's actually a fire.
That's a good analogy, yes.
Wow, what an incredible journey through audit data analytics. It really feels like we've seen how these tools are moving auditing from looking at tiny pieces to understanding the whole data landscape.
Absolutely. They empower auditors to make sense of these massive data sets in ways that just weren't possible before. It's a shift from sampling to a much more holistic, data-driven approach.
And hopefully, for you listening, you've got a much deeper understanding now of this really critical practice in modern auditing. We wanted to pack it with real-world examples and those aha moments.
Yeah, helping you get quickly informed on how this technology is changing the field.
So, looking ahead, as data just keeps exploding, where do you think ADAs might go next?
That's the fascinating question, isn't it? Maybe towards being even more predictive, perhaps even helping to prevent issues before they become material misstatements.
Transforming the audit from looking back to being more like a real-time pulse check on the business.
It's definitely heading in that direction. Imagine audits becoming less of a year-end event and more of a continuous assurance process. That's a powerful thought.
It really is. And maybe think about how these analytical ideas, finding patterns, asking why, predicting outcomes could apply in your own work, or even just in making everyday decisions.
Definitely. The principles of data analysis are becoming fundamental skills everywhere, not just in auditing.
Well, that's all the time we have for this deep dive. Thanks so much for joining us.